Divorce is already one of the most stressful and emotionally draining experiences a person can go through. Amid the heartbreak, legal paperwork, custody battles, and uncertainty about the future, many women make a critical financial mistake that can cost them tens or even hundreds of thousands of dollars. They focus on the obvious: joint checking and savings accounts, credit card statements, tax returns, and retirement accounts. They gather pay stubs and mortgage documents. But there is one specific bank statement that far too many women overlook, and it often hides the biggest financial surprises. That statement? The old joint bank statements from 12 to 24 months before separation, especially the ones that show patterns of transfers, withdrawals, or sudden changes in spending that no longer appear in recent records. Here's why this forgotten statement matters more than almost anything else, and exactly how to use it to protect yourself. Why most women miss this statement. When divorce proceedings begin, lawyers and financial advisors usually ask for the most recent 6 to 12 months of bank statements. That makes sense on the surface. Recent activity shows current cash flow, debts, and lifestyle. But the real story, especially if one spouse has been planning or hiding assets, is often buried in the older records. By the time divorce talks start, clever spouses or their advisors have already cleaned up the paper trail. Large unexplained withdrawals, regular transfers to unknown accounts, or sudden increases in cash spending disappear from the newest statements. The older statements reveal the before picture, what normal spending looked like when things started changing, and where money might have quietly moved. Many women assume if it's not in the recent statements, it doesn't exist. That assumption can be devastating. The most common hidden patterns. This statement reveals: 1. Secret transfers to unknown accounts. Look for recurring ACH transfers, wire transfers, or Zelle, Venmo, PayPal payments to accounts or people you don't recognize. Even small, consistent transfers can add up to significant sums over time. In many cases, these lead to hidden individual accounts opened in the spouse's name only, or in a family member's name. 2. Unexplained cash withdrawals. A sudden spike in ATM or cash withdrawals is one of the biggest red flags. Cash is the easiest asset to hide because it leaves almost no trail. If your spouse suddenly started taking out $500 to $1,000 in cash every week or two starting 18 months ago, that money didn't just vanish. It likely went somewhere. 3. Payments to consultants, friends, or family. Check for payments labeled vaguely as consulting fees, loans to family, or transfers to relatives. These are classic ways to park marital money outside the marriage. Later, during divorce, the spouse might claim it was a legitimate debt or gift. 4. New credit cards or lines of credit. Older statements often show when new credit cards were opened or when balances started climbing dramatically. These can be used to drain joint resources or build hidden debt that affects your credit and settlement. 5. Changes in direct deposits or payroll. If income suddenly shifted or bonuses stopped appearing in the joint account, it could mean money was being redirected to a separate account or deferred. Real stories that show how much this costs. Countless women have shared stories online and in divorce support groups about discovering too late that their spouse had been siphoning money for months or years. One woman found $87,000 in unexplained cash withdrawals spread over 14 months on old statements. Another discovered regular $2,000 transfers to an account in her mother-in-law's name that had never been mentioned. In both cases, the money was gone by the time the divorce was finalized, and recovering it required expensive forensic accountants and court battles. Forensic accountants report that hidden assets or undisclosed income appear in roughly 20 to 40% of contested divorces, with the majority involving the higher-earning spouse. Women, who statistically still earn less and often handle less of the day-to-day finances, are disproportionately affected. How to properly review the critical statements. Don't just glance at the totals. Treat this like detective work. Gather at least 24 months of statements for every joint and individual account you know about. Use highlighters: green for income deposits, yellow for anything suspicious or unknown. pink for large cash withdrawals or transfers. Create a simple spreadsheet tracking monthly totals, unusual transactions, and patterns. Compare spending patterns from 2 years ago versus the last 6 months. Dramatic shifts almost always mean something changed. Look at the memo or description line on every transfer. Vague entries deserve extra scrutiny. Check for accounts that suddenly went dormant or were closed. The money had to go somewhere. If anything looks off, do not confront your spouse immediately. Document everything first and consult a divorce attorney and possibly a forensic accountant before tipping your hand. Beyond bank statements, the full financial picture. While the old bank statements are the most commonly forgotten piece, they work best when combined with other documents. Tax returns for the past 3 to 5 years. These often reveal undisclosed income or investments. Credit card statements. Look for charges at unusual locations or for services you don't recognize. Retirement and investment account statements. Business records if your spouse owns or works in a business. Life insurance policies and beneficiary designations. Many divorce attorneys recommend pulling a full credit report for both spouses as well. It can reveal secret loans or accounts opened without your knowledge. Protect yourself before you even think about filing. The smartest move is to start gathering these documents quietly and privately long before you announce separation. Open your own separate bank account if you don't have one. Begin building your own credit. Make copies of everything and store them securely outside the home. Cloud storage with strong passwords works well. If you suspect financial deception, speak with a divorce attorney experienced in high-asset or complex cases before you file. In many jurisdictions, once divorce papers are served, the other spouse may move quickly to protect or hide assets. The bottom line: divorce is painful enough without discovering months or years later that you left significant money on the table because you missed one key set of documents. The forgotten bank statements from 12 to 24 months prior often contain the clearest map to hidden assets, changed behavior, and financial manipulation. Taking the time to review them thoroughly can mean the difference between walking away with a fair settlement and struggling financially for years after the divorce is final. If you are even thinking about separation or divorce, start gathering and reviewing those older statements today. Knowledge is power. And in divorce, it can be the difference between security and regret. Women going through this deserve to protect their future and their children's future. Don't let an overlooked bank statement become one of your biggest regrets. What financial red flag have you discovered or worried about during divorce preparations? Share your experience in the comments, anonymously if you prefer. If this video helped you, please like and subscribe for more practical, no-nonsense advice on protecting yourself financially during life's toughest transitions. Your future self will thank you.